Dan, welcome. We need your steady hand this morning because we kind of had that rate fear last week. Are you afraid of higher interest rates?
No, because rates are rising because earnings and because there's positive growth in the United States. And I think the upcoming earnings season is going to be very good. Stocks are traditionally weak seasonally this time of the year, so it doesn't surprise me that we're seeing some weakness. We're also right in front of earnings season, so there's nothing really companies can say to counter any moves in their individual shares because they haven't reported yet.
The bears would say that higher rates, if anything, risk two big risks. Number one, you slow the economy because consumers have to pay more for the stuff they buy. Number two, it needs to bring the multiple down for the stock market because now you're competing with rates. You've also got the cost of funding, which should bring down valuations.
So the last time we visited, I showed you a chart about the price earnings multiple of the stock market at the beginning of the year and where it is now, and it's actually somewhat lower despite the rising markets. That's because profits growth is so robust and should continue to grow. So that's where we see things going right now. Valuations are reasonable, but I think it's going to be much more about individual stocks and sectors versus just the whole market rising and falling.
You know, look at that chart, Dan. So the white line, by the way, we're seeing bond yields, and we're seeing the market here. I mean, it is, and if you're on the radio, it's a dramatic difference. In other words, they're going in opposite directions, probably because more of the bond move that we're seeing.
Right.
There's a lot of worry. Everything you read is rates are going to crush stocks.
Right.
Why is that sort of theme, in your mind, incorrect overall?
Well, it depends on how fast rates rise. If we get an interest rates moves that are so quick.
It was quick last week.
It was a little bit quicker than usual, but not out of a range of what would be considered normal. And let's also calibrate things. We're still at 3% on the 10-year.
I know that. Historically, that's low. I get it.
Yeah.
I think it was the rapidity of the rise and maybe the hawkish tone that we heard from the Fed and, of course, that hot jobs number that got people spooked.
And also the fact that we did get a trade deal with Canada. So you have Mexico and Canada. You have the framework for both of those deals that will get ratified next year. All eyes are going to focus now towards China because I think this puts enormous pressure on the Chinese to come with some kind of a deal with the United States. They're the big loser in this if they don't come to some sort of an agreement with the United States.
And their market is suggesting that the Chinese domestic stock market opening up after being closed all last week, down nearly 4%.
Right.
The Bank of China is making moves, as you saw. Talk to us quickly about how we can protect ourselves with something that is both a floor cleaner and a dessert topping.
And that would be convertible securities. So a convertible, as you say, it's two diametrically different parts of the capital structure.
It's a preferred stock and effectively a mini bond.
A bond or a common stock or a preferred and common stock. So you do get the underlying move of the underlying stock. It's one of the only fixed income asset classes that can actually perform well in a rising interest rate environment.
It can. Historically, that rates go up, convertibles can do well.
Because rising rates mean that call option, if you will, that's embedded in the bond or preferred has more value. So that offsets any declines that you might experience in the bonds themselves. Plus, those securities are typically issued with 5 to 7 year maturities. So
well, everybody's looking for opportunity in this very interesting market. Suddenly it got more interesting last week. We're looking at convertibles. Dan, we appreciate your steady hand. Thanks for coming in.
Thank you.